Can finance really help save the planet? What if money could fight climate change, fund clean energy, or build eco friendly cities? That's not just a dream, it's happening through something called green bonds. In today's video, we'll explore how the financial world is going green. Welcome back to bizcasestudio, where we break down business concepts and case studies in a simple and a practical way. If you're new here, consider subscribing for more sustainable investing and MBA topics. Today, we are diving into the fascinating world of green bonds and how they're transforming finance for good. Green bonds explained what they are, how they work, and why businesses and governments are using them to finance sustainability. Let's dive in. Let's start with the basics. A green bond is like a regular bond. It's a loan that investors give to a company or government. But there's one key difference. The money raised through green bonds must be used only for environmental projects. This includes things like renewable energy, energy efficient buildings, clean transportation, or even sustainable agriculture. It's a way to fund eco friendly projects while still operating within the financial markets. So, how do green bonds work? Step by step. A company or government issues a bond. That's basically saying we need funds for a green project. Investors buy the bond and lend them money. The issuer uses that money specifically for approved green projects. This is often monitored or verified. Over the time, the issuer repays the investors with interest. Investors get a return plus the satisfaction of supporting environmental progress. So, that is a step by step of how these green bonds actually work. Now, let's clear up a common confusion. There are actually three types of sustainable bonds. Green bonds focus only on environmental issues like solar farms or reducing carbon emissions. Second is social bonds, funds social projects like affordable housing, education, or healthcare access. And the third is the sustainability bonds, a mix of both addressing environmental and social goals in one bond. All three help connect capital to impact, just in different ways. Let's bring this to life with a real world case. In 2016, Apple became the largest US corporate issuer of green bonds. As of today, Apple has issued over $4.7 billion in green bonds. What did they use this fund for? Energy efficient building design, which is we all have seen, I think, hopefully, carbon free aluminum production, solar and wind energy projects, improving recycling technology in their supply chain. Apple also publishes regular impact reports to show investors exactly how the money was used, proving transparency and accountability. This is a textbook example of how green bonds should be managed. You might wonder, why would a company like Apple issue green bonds instead of just using regular funds? Here are some smart reasons. It shows their commitments to ESG, environmental, social, and governance principles. It attracts responsible investors who care about sustainability. Sometimes green bonds offer lower interest rates, called the greenium, and it boosts the brand image as a climate conscious leader. So it's a win win, better financing terms, and a stronger public reputation. Green bonds sound great, but they are not perfect. Let's look at both sides. Let's see the benefits first. They move real money into sustainable development. Companies and governments gain credibility for climate action. Investors get a way to support causes they believe in. And now let's see the challenges. Greenwashing. Some issuers may label bonds as green without real impact. There's no global standards, so definitions vary. Independent verification and reporting can be expensive and complex. That's why transparency and regulation are key. Here's the big takeaway. Green bonds are a powerful tool that link the financial system with global sustainability goals. They prove that finance isn't just about profit, it can also fund real change. For MBA students, professionals, and investors alike, green bonds represent a growing shift, one where markets drive both returns and responsibility. Let me ask you this. Would you invest in a bond that gave slightly lower returns if it helped reduce emission or built a cleaner city? Where should the line be drawn between profit and purpose? Let me know your thoughts in the comments below and let's discuss. Thank you for watching this case studio. If you found this helpful, please like and share and subscribe. We have got more real world sustainable investing videos coming your way. And the next video is how ESG ratings and sustainability indices work. See you in the next video. Take care. Thank you.